When to buy, when to sell, and when to sit still. The market is not random. It moves in rhythm. It breathes. It expands and contracts like lungs filling with oxygen and then releasing it. Most people lose money not because they lack information, but because they lack timing. They buy when they feel safe. They sell when they feel scared. But wealth is built in reverse. If you want to understand when to buy and when to sell, you must first understand cycles. You must understand interest rates. You must understand trend. You must understand fear. And you must understand yourself. Interest rates, the silent force behind everything. Let's start at the foundation. Interest rates. When interest rates increase, liquidity tightens. Money becomes expensive to borrow. Businesses slow down. Consumers slow down. Growth slows down. And when growth slows down, markets typically pull back, sometimes aggressively. Historically, increased interest rates apply downward pressure to stocks and crypto. Why? Because capital rotates away from risk and into safety. Now flip it. When interest rates decrease, liquidity expands. Money becomes cheaper. Borrowing increases. Risk appetite increases. Markets often rise. Rate cuts generally lift markets. But here's where discipline comes in. Not all rate cuts are bullish. If rate cuts happen because the economy is strong and inflation is under control, that's fuel. But if rate cuts happen because fear is rising, because a recession is forming, because a pandemic hits, because the system is stressed, those rate cuts can signal deeper trouble. And historically, rate cuts based on fear have often preceded crashes. So the question is not just, are rates going down? The question is, why are they going down? Context matters. Always. Swing trading only in bull markets. Now let's talk strategy. Swing trading is powerful, but it is not meant for chaos. Swing trading works best in bull markets. Why? Because in bull markets, higher highs and higher lows dominate. Momentum flows upward. Pullbacks are temporary. Confidence supports continuation. But when markets are choppy, uncertain, or forming new all-time highs after extended runs, that is not where you want to aggressively swing trade. New all-time highs often bring pullbacks. When price stretches too far from structure, corrections reset it. Swing trading during uncertain pullbacks is like trying to run uphill on loose gravel. Instead, wait for clarity, wait for higher lows, wait for continuation structure, trade with the trend, not against it. Higher highs and higher lows, the language of trend. An uptrend is simple. Higher highs, higher lows. That's it. When price makes a new high and then pulls back but holds above the previous low, that is strength. The safest entry in an uptrend? The higher low. Because that's where risk is defined. Yes, you can enter at a breakout, at a higher high. But understand something. Breakout entries often come with corrections. Price may push higher, then retrace before continuing. If you enter at a higher high, you must accept volatility. If you enter at a higher low, you enter at structure, and structure reduces emotional stress. Trade structure, not excitement. The 200 EMA, a line of volatility. Now let's talk about something technical but powerful. The 200 EMA on the daily time frame. Historically, when stocks fall under the 200 EMA, volatility increases. Institutions watch this level. Algorithms react to this level. Retail investors panic at this level. When price drops below it, fear accelerates. But here's the deeper truth. Some of the greatest long-term buying opportunities have occurred when strong assets dip under the 200 EMA during broader market corrections. Not blindly, not emotionally, but strategically. Because when volatility rises, opportunity expands. And if you zoom out, many historical recoveries began from those areas of extreme fear below long-term moving averages. So instead of panicking at the 200 EMA break, ask, is the asset fundamentally strong? Is the macro environment stabilizing? Is fear extreme? Because volatility is not the enemy. Unpreparedness is. Pivot zones. The line between strength and weakness. There's something powerful in between trend lines. It's called a pivot zone. A pivot zone is the area where price repeatedly reacts. It's the battlefield between buyers and sellers. Above it, strength. Below it, weakness. When price approaches a pivot zone, watch closely. If buyers defend it and price bounces, continuation is likely. If sellers break it with strength, downside momentum may follow. This is not magic. This is structure. Markets leave footprints. And pivot zones are where decision making reveals itself. Don't guess direction. Wait for confirmation. Let the pivot zone show you who is in control. When the market is going down, protection over hope. Now let's talk about downtrends. When markets are clearly trending downward, lower highs and lower lows, hope is not a strategy. This is where put options can be used strategically. Put options allow you to potentially benefit when stocks fall. But again, this is not gambling. This is tactical positioning. You don't use puts in a healthy uptrend. You use puts when structure confirms weakness. Lower highs, lower lows, breakdowns under pivot zones, loss of the 200 EMA with strong selling pressure. That's when defense becomes offense. The key is this: you don't marry puts. You use them during the storm, and when the storm ends, you rotate back into strength. The fear and greed index. Emotional compass markets are emotional machines. That's why the fear and greed index is powerful. When the market is extremely fearful, that's often where bottoms form. Not immediately, not perfectly, but fear compresses price, and compressed price creates value. When fear dominates headlines, that is when disciplined investors accumulate heavy, not recklessly, but confidently. Now flip it. When the market is extremely greedy, when everything is green, when everyone feels invincible, risk rises. That's when you slow down. That's when you stop buying aggressively or rotate into safer, undervalued stocks that are rising steadily, not overextended hype plays. Greed blinds risk. Fear reveals opportunity. When to buy when. The market is forming higher lows in an uptrend. Interest rates are decreasing for healthy economic reasons. Fear is high, but fundamentals remain strong. Strong assets dip below long-term averages during broad corrections. Pivot zones hold and confirm continuation. Buy into strength at structure. Buy into fear with discipline. Buy when the macro environment supports growth. When to sell when the market shifts from higher highs to lower highs. Pivot zones break with conviction. Price loses key structure and fails to reclaim it. Greed is extreme and valuations stretch beyond reason. You entered at a higher high and correction begins. Manage risk. Selling is not weakness. Selling is preservation. Capital preserved is capital that can be redeployed. The hardest trade, sitting still. Sometimes, the smartest move is no move. When structure is unclear, when rates are uncertain, when volatility is directionless, when price chops between pivot zones, that's not a buying signal. That's not a selling signal. That's a waiting signal. Patience is a position, and patience compounds. Final truth: interest rates shape liquidity. Liquidity shapes risk appetite. Trend reveals structure. Pivot zones reveal control. The 200 EMA reveals volatility. Higher highs and higher lows reveal strength. Lower highs and lower lows reveal weakness. Fear reveals opportunity. Greed reveals danger. But above all, your discipline reveals your future. When to buy and when to sell is not about prediction. It's about alignment. Alignment with macro forces, alignment with trend, alignment with emotional control. And the investor who masters alignment will not chase, will not panic, will not react blindly. He will observe. He will wait. He will execute with precision, because markets don't reward excitement. They reward discipline, and discipline is wealth in motion.